And it looks like we are now on YouTube. So I think we're in good shape. And so we will proceed with introductions of the committee. It's been a little while since we have seen each other. And this morning I woke up thinking that I had to remember how to run a meeting because it's been a few months. So with that said, I will start with Representative Evans. Go ahead.
Good morning, Madam Chair. I am Richard A. Evans, representative from House District 120, serving the towns of Addison, Dover, Foxcroft, Brownville, Medford, Milo, Lakeview, Plantation, and Ornerville Township. Could feel better, Mark.
And next we'll go to Representative Connor.
Morning. Thank you, Madam Chair. My name is Representative John Connor, and I represent the good people of Lewiston.
And Representative Matheson.
Good morning, everybody. My name is Christy Matheson. I represent District 1, which is Kittery.
Representative Arford.
Good morning, Madam Chair. My name is Representative Poppy Arford, and I represent District 49, the western part of Brunswick.
Representative Blyer.
Thank you, Madam Chair. Good morning, everyone. I'm Representative Mark Blyer. I represent District 22, which is all of Leamington and part of Buxton, Standish, and Limerick.
Representative Melrano.
Good morning. I'm Gina Melrano. I represent House District 62, which is part of Auburn.
Representative Brooks.
Good morning. My name is Heidi Brooks. I represent House District 61, which is part of Lewiston.
Representative Morris.
Good morning. I'm Representative Joshua Morris. I represent the towns of Turner, Leeds, and Livermore.
Representative Tepler.
Good morning. I am Denise Tepler. I represent House District number 54, which is all of the town of Topsham, and I serve as House co-chair of the committee.
Excellent. And I am Heather Sanborn. I represent Senate District 28, which is half of Portland and half of Westbrook. And we are helped today by our analyst, Colleen McCarthy-Reed, who is doubling as our clerk for the day, in addition to being our analyst. And I'll let the committee know that we have invited Veronica Snow back to be our committee clerk when we reconvene in January. So we're excited to have her back, and hopefully some in-person meetings if we can get the COVID situation under control so that we can enjoy her delicious baked goods in addition to getting to see each other in person. So the purpose of today's meeting, as you guys know, is for us to get a briefing from the Bureau of Insurance with regard to long-term care insurance. This is a topic that we have talked about as a committee in the past, but I think not in this session of the legislature. And we did have a number of new members on our committee, and with some rate increase notices going out to our constituents, I felt that it was a good idea for us to convene in the interim here in order to get a briefing from the Bureau and be able to ask questions from the subject matter experts within the Bureau about what we should tell our constituents and about what the circumstances are that are leading to these rate increases. So that's the purpose of the meeting today. There's no specific piece of legislation that we're considering. And so this isn't a public hearing, but instead just an informational briefing for us to be able to better understand the situation as a committee and provide that leadership back to both our own constituents and other legislators who might reach out to us for assistance when they hear from their constituents. So with that stage setting, Representative Tepler, go ahead.
I just want to add that not this past session, but the session before, I sponsored a bill that requires the insurance companies to notify their insurees, is that the right word? When they are filing for an increase. And so part of what's happening now is people are getting these increases notices, which is something that they haven't gotten in the past. And it also does give them an opportunity to communicate with the Bureau of Insurance to indicate their sense of how the increase is potentially problematic. And I see Senator Brenner has joined us.
Senator Brenner, go ahead.
Morning, my name is Stacy Brenner and I represent Senate District 30, which includes Buxton, Scarborough, and Gorham. Sorry I'm late. It's not practice.
Excellent. So with that context, thank you, Representative Tepler. With that context, I think I'll turn it over to Colleen to bring in the folks from the Bureau and share their presentation with us. Oh, Representative Evans has his hand up. Go ahead, Representative Evans.
Yes, thanks. I just wanted to follow up with Representative Tepler. You said the bill was passed a couple of sessions ago, and it is in law, in fact. Okay, thanks.
Yep, I think it's one of the reasons that we heard from our constituents this year was that they got better and earlier notice about their rate increases this year, which just sparked more communication with the delegation. Representative Connor.
Thank you, Madam Chair. Could we get that that LD number just so I can go back and look it up and read up on it to educate myself, please?
Yeah.
I'll drop it in the chat after we get started. I think the superintendent is here and Ben Yardley is here and Marty Hooper is here. I'm not sure who is going to do the presenting, but I can pull the slides up, and if folks just want to let me know when you want me to start sharing my screen, Bureau folks, and then just prompt me when you want to move from slide to slide. But maybe they'd all introduce themselves first and then we'll get going.
Okay, I'm Eric Chop. I'm the superintendent, and it's nice to be here and good to see everyone. I wish it was in person as well, but hopefully that day will come before too much longer. And I'm here with Marty Hooper and Ben Yardley. Marty's the PNC, is the life and health actuary who reviews the long-term care filings, and Ben's a senior staff attorney. I'm going to start off, and then Marty's going to go over the specifics of how we deal with rate filings, and then I'm going to talk a little bit about NEIC activities. And Representative Tepler mentioned the law that required notice, which is a good thing. And the Genworth filing is truly astounding. It's an excess of 100% rate increase. I can't say too much about it since we're still reviewing it. But I have I'm going to hold on December 2nd a forum, and Genworth is going to mail each policyholder. We're going to have a public forum to give the opportunity for consumers to weigh in on this filing, and we recognize the significance of what Genworth is asking for. But I'd like to give a little background. And long-term care as a whole across the country, this is happening in every state. Maine is by no means unique in what's going on. It's probably the most problematic line there is out there, and every state is affected. And what I'm going to do is give a background of what the industry and give some examples of what's going on with specific companies, just to give you some context of what, with our balancing act here. So Colleen, could you do the first slide, please? And it goes without saying, interrupt me anytime with questions. Next slide, please. And next slide. Okay, just a little background on long-term care insurance. It's been around for 40 years, started as nursing home only policies. In the 80s, it really took off where there was in the 90s, there were over 100 insurers selling long-term care insurance. We're down to 7 in Maine and about a dozen nationally. And the remaining companies are those that are still around are in runoff, and that's usually not a good situation. A little bit about the product itself. It's guaranteed renewable. They can't raise it based on medical conditions. They can't raise premiums. And it was sold and designed to be level funded, which means the premium sold was designed to be level over the course of a person's life. However, the contract does allow for rate increases. So, you know, consumers rightfully thought they're buying a level term premium, but every contract I've looked at does allow for rate increases, and virtually every company is increasing rates across the board, across the country. Next slide, please. So what went wrong, and this is, again, the consumer is completely harmless here. The insurers just got it wrong. They got the interest rate wrong. When they designed the product, they assumed, you know, 6 to 8% interest. Interest rates, we've been in a low, it's called low for long interest rate environment for several years. That is perhaps one of the most significant elements of what's gone wrong in their experience. The lapse rates. The lapse rates are a little bit about lapse rates. When insurers design products, they count on some people dropping their policy, and that pot of money that they've contributed goes towards paying claims for everyone else. It's called the lapse rate, and it's common in life insurance. You know, they assume people are going to drop life insurance, and that pot of money goes to pay claims. They assume it would be between 4 and 5%. However, it's been under 1%. That means insurers recognize the value of this product, but again, that created the deficit. It has helped create the situation. The lapse rate, they got completely overestimated the amount of people they thought would drop the policy. Morbidity, they didn't really anticipate Alzheimer's or other long duration diseases. People are living longer and going to nursing homes earlier. And so these factors combine to create the situation we're in. Again, and the consumers just bought the product, but be that as it may, this is a situation that exists, and the carriers are responding by filing rate increases. But next slide, please. And this is a but. There's significant activity going on, and this is by no means an exhaustive list, but just some of the reserve carriers are reviewing their reserves as long-term care reserves to see if they're adequate under the circumstances as they exist today. This is a reinsurer, the first one, a $14 billion deficit. Unum, $2 billion deficit. I mean, and I could go on and on, but these are reserve deficiencies. These are strong, healthy companies, but they are under reserve, so they have to increase their reserves to make sure they have enough money set aside to pay claims. And again, this is no means exhaustive, but these are big numbers. Next slide, please. But this is where the rubber really starts hitting the road, especially monoline carriers for long-term care. There have been several insolvencies. Penn Treaty, this is over $1 billion deficit. It's into the guarantee fund. There's not a lot of main policy holders. And Time Insurance Company is another insolvency. And this one, you're seeing companies trying to be more and more creative, and I use creative approach to deal with this block of business on their books. And Time it tried to re-domesticate to Puerto Rico. The regulators banded together and stopped that. It went back to Wisconsin. It's been put into liquidation, and well, it's in rehab and it's heading towards liquidation. Next slide, please.
I did see a hand. I don't know if you can see him, Senator Sanborn, but Representative Tepler has her hand raised. So
thanks. I couldn't see it because it's the same color as the background.
I know. I think it is hard to see, but yeah, sorry. I didn't mean to interrupt, but.
No, go ahead, Representative Tepler.
Thank you. I'm sorry. Yes, it is a little hard to see with this wood door behind me. I just wanted to ask the superintendent, first, thank you for being here, Superintendent, and for all this information. I'm wondering if we know, in terms of the 7 companies that offer this insurance in Maine, do we know what their overall profit versus loss picture looks like? Not just in the LCTI line.
Well, we do. I mean, that's why, like Unum, the $2 billion deficit, reserve deficit, they're funding that out of, they're funding that out of earnings. I mean, when,
And I guess I'd just like to know what their earnings look like.
well, it varies by company, but it's a monolines company that are really experiencing the problem. Excuse me. But there's no, the law doesn't allow me to take into account the earnings, the rate increase, the rate filing stands on its own. But we do consider that, but the way the law works, it's a rate filing, it's on its own, it's a standalone product. I mean, I don't mean that literally, but it is. I mean, when we review the rates, it's what's the experience been for that line of business for that company. And that's.
And is that federal law, superintendent, or state law?
State law. There's no federal law relative to that.
So potentially we could change state law that would indicate for those companies that aren't monoline insurers that other areas of profit need to be considered.
Well, potentially
rate filings.
Potentially, you really want to think about that, because that really places a company at a disadvantage when they're selling their other lines of insurance. I mean, you know, you want a company to remain financially viable and strong. And if that requirement is in statute, it could be that that cross subsidization would make their other lines non-competitive, and then you could exacerbate the problem for the company from a solvency perspective. So it's tempting, but you really want to be careful with going down that road.
I understand and appreciate your answer and your concern. I am very concerned about the consumers in this situation who happen to be elderly and often on fixed incomes. So, but go ahead and please continue your presentation. I just wanted to ask about overall profit, and but I understand the issue there. Thank you.
And I will say, when I was NAIC president, the long-term care issue was the #1 issue during my year. I mean, it is. These are the most elderly, these are the most vulnerable population. And if we're not here to protect them, who are we here to protect? So I get it. Next slide, please. This is something I want to go down this rabbit hole of SHIP, because this is an example of something that's going on that's really detrimental to policyholders, but it's an example of what happens when a company gets into financial problems. As you can see here, in 2018, the deficit was 466 million. Placed into rehab in early 21 and early 2020 rather. The current deficit is 1.2 billion. There's 30,000 remaining policyholders of the over 300,000. Policyholders, and there's a two-phase plan rehab. Next slide, please. This plan, this is unprecedented. Maine, Massachusetts, and Washington intervened in the Pennsylvania court proceeding. We intervened the 3 states to better understand the plan. As we got into it more and more, we became very, very concerned about the aspects of the plan. Again, it's 30,000 policyholders that are left holding the bag for a $1.2 billion deficit. South Carolina and Louisiana filed actions in state and federal court respecting Pennsylvania's authority to approve a plan. And one aspect, and this is, believe it or not, the least troubling, at least to me, is the Pennsylvania plan allows the Pennsylvania insurance, the rehabilitator from Pennsylvania, to set the rates for the country for every state. And we believe that violates the Constitution, the fair, not an attorney, drawing a blank on full faith and credit clause of the Constitution. That's one issue with the plan, but to me, when we peel back the onion of the plan, it puts policyholders in a worse position than in liquidation, which is in violation of the Supreme Court opinion, and that cites the case. In other words, when you look at the plan, it's by keeping it in rehab, it's keeping it out of the guarantee fund, and the guarantee fund is designed to spread the cost of an insolvency. Here, they're concentrating it among the remaining policyholders, whose average age is, I think, 86 for policyholders and 89 for claimants and non-claimants, they're not actually they're not honoring the waiver. So you're going to find people in a nursing home who could potentially get a bill when they thought they're on waiver of premium. Now, there's only 300 policies in Maine, but this could be a precedent for other insolvencies, and it's very disconcerting. And, the guarantee, if they put it in the guarantee fund of the $1.2 billion deficit, the guarantee fund will pick up about 800 million nationwide, and there'd be about 300 million picked up by policyholders. And this is in sharp contrast to Penn Treaty, which was a Pennsylvania company, which they got put in liquidation. And unfortunately, the judge that heard this case, when Penn Treaty with a different insurance commissioner from Pennsylvania, she wanted, this was her idea, this was her, she felt it was unfair to taxpayers to put the company into liquidation, so it should stay in rehab. And to me, that's setting policy. The legislature has said when a company's insolvent, the guarantee fund is much like the FDIC. It's there to protect policyholders, to spread the cost of insolvency. And to take that analogy a little further, it's like the FDIC saying you're to a bank, to a deposit holders of a bank, where your bank made stupid investments, you're not going to get FDIC protection. So it's facing the entire insolvency, $1.2 billion on the backs of policyholders, which is I'm very troubled by. And we lost at the court. It's analogous to Superior Court. I'm not sure what it's called in Pennsylvania. And we're appealing to the Pennsylvania Supreme Court. And last count, we have 20 states. We're applied for a stay at the court that ruled against us. They denied it. We've applied for a stay in the state to implementation of the plan to the Supreme Court. And last count, 20 states are filing an amicus in support of us. But this is a sort, and I bring this as up an example. This is a sort of, Pennsylvania, I don't think they have nefarious intention. I just happen to disagree strongly with their approach here. But if we don't solve the long-term care problem, this is the sort of activity that's going on. And I pointed out it's a rabbit hole that I thought was important to make the committee aware of. This is it's an important case, but this could set precedent. I mean, there's never been an rehab plan. Most rehab plans are designed to bring a company back to solvency. The special deputy rehabilitator for Pennsylvania admitted on the hearing that it's highly unlikely that the plan will bring SHIP back to a solvent position. So we feel liquidation is inevitable. And finally, I'll stop after this next comment. They're in the process of, the reason we applied for a stay, they're going to be shortly sending out to policyholders options for premium reductions or benefit reduction, premium increases or benefit reductions. And the consumers are going to have to make an election and the Pennsylvania rehabilitator is going to send this out. If liquidation is inevitable, like we feel it is, we think it's the action of the Pennsylvania department, these elections policyholders make are going to be permanent. In other words, if they make an election to pay an increased premium or take a benefit reduction, and the company goes into liquidation like we think it will, those elections are permanent. In other words, if they elect benefit levels below the guarantee fund limit, they have to live with it. And we're very concerned with that. So, I mean, I could do a whole hour briefing on this topic alone, but it's illustrative, but this is precedent setting, and I'm very concerned about the effects of this, and it's before the Pennsylvania Supreme Court, and briefings are due the end of December.
Thanks, Superintendent. Superintendent, can you speak a little bit more broadly, or maybe this is something for one of the other folks from the department or the Bureau that's going to cover, but can you talk about what happens to policyholders when a company is put into liquidation? and how the guarantee fund works and who's funding the guarantee fund, if it's a state by state sort of situation, or how that works.
Guarantee fund is a state by state, but there's a national association called NOGA that kind of coordinates, but it's state by state. It's funded through assessments on insurance companies, but there is a tax offset that the legislature decided. I mean, that to me, that's no different than funding the gas tax. The legislature decide how to fund it. And that's just the way it is, but it's funded by assessment on insurance companies. In Maine, the cap for long-term care policy is 300,000. So no matter what's paid to date, going forward, if I place a company in liquidation, the guarantee fund takes over, they adjust the claim, it becomes their claim, and they're responsible for up to 300,000 in benefits. But also, they're also a creditor. They're entitled to a portion of the estate. So in addition to 300,000, there is a chance they can get more benefits from the estate. And that's true. Although yet again in Pennsylvania, there's another case called Warrantech that this same judge has ruled that policyholders are not entitled to proceeds from the estate. So but it's a state by state, funded by insurers. It's much like an FDIC plan, and to date it's worked very well. I mean, and long-term care is no exception. I mean, there's no reason long-term. This is basically saying a long-term care policyholder is not entitled to guaranteed fund coverage, in my opinion.
So how long does $300,000 in benefits last? At this point, if you need nursing home care, do you have any sense of whether that's a year or more?
It's probably no more than 3 years, but
okay.
That's numbers I've seen. I've seen the nursing home in Maine is like 90,000 a year.
Okay.
You get that number too, but.
And what does the typical benefit structure under a policy like this look like?
It varies. Some are indemnity and some are expense-based. Most of them, Marty will get into it, but like partnership policies have inflation requirements. So I think it's 3 or 5%. Well, it's 5% starting off with. So you have your benefit increases each year by the amount of interest in the policy, and it's compounded. So you have some policies that are very, very rich. I mean, extraordinarily rich, in excess of the guarantee fund cap for sure. Most policies probably are not, but you have a significant number that would likely be. So again, it's in our interest to keep it out of guarantee funds. And that's where the rate increases come in. I mean, liquidation should only be a last resort. And that's clear, but it's incumbent upon us to figure out when a company there's no other option for a company. Alternative rather.
Okay. I see some hands. Representative Evans, go ahead.
Yes. Commissioner, did I understand you to say that there were 300 people, policyholders in Maine? Or is that's probably a floating number?
It's 300 in Maine relative to SHIP. Yes.
For that one company that we've been discussing. Okay. Representative Barford, you're on mute.
I want to make sure when you referred to taking a percentage of the estate, are you referring to the policyholder's estate or some other estate?
No, I'm referring to the company estate.
Okay. And how does that, you're talking about what's basically left in the insolvency distribution?
Yes.
Okay. Thank you.
Senator Brenner.
Thank you, Madam Chair. Just to follow up to Representative Evans' question, can you give us a number, as you know it right now, of long-term care insurance policyholders in the state that are remaining?
Perhaps Marty can. I can't. I know Genworth has in excess of 4,000. So it varies by policyholder, but I don't have that number off the top of my head.
Thank you.
Ms. Hooper, do you have that number?
I don't. We do have numbers as the filings come in. the companies are required to let us know, but we don't have an overall, it changes. I was just gonna look, so the Genworth filings that we're looking at right now, and people are getting their letters. In Maine, there's 4,094. And this is, I think it's 8 filings. So we don't have a total, because as Eric mentioned, there were roughly 100 companies selling, and those policies are guarantee renewal. So we have some very small pockets of business with companies, and then we have some companies like Genworth that have quite a few.
Representative Bleier.
Thank you, Madam Chair. Thank you, Superintendent. So I have a couple questions. The first question is, if it goes into liquidation and they get $300,000 in benefits through the insurance, if it's only 3 years, if someone's been paying a premium for a number of years, and after the 300 of insurance premiums are paid, what happens to that client at that point? And the second question I had is that if you don't want to go into liquidation and you want to increase rates, what happens if somebody's paying rates for a number of years and their rate hike, they can't afford that rate hike? What happens with all those years worth of payments?
I'll take the first one, the second one first. I mean, one of the work streams of the NAC, and Marty can speak to this as well, is we're requiring carriers to offer options to policyholders to mitigate the rate increase. But it's in the form of reduced benefits, but usually it's like the interest rate. If it was issued at 5%, by reducing it to 3%, you can greatly reduce the amount of rate increase. You can increase the elimination period. In other words, the waiting period for until you get benefits. You can reduce the duration of benefits. We're requiring, they've got to offer consumers options, and we're trying to standardize that through the NAC. But for years in Maine, Marty's team had been saying, the increase is justified actuarially, which is our job to arrive at that conclusion, whether or not it is or isn't. But once it is, and some of these increases are significant, they've got to offer consumers options, or they've got to phase it in. We're insisted on that. In answer to your first question, it's no different than the FDIC. If you're above the limit as a deposit holder, there's no recourse. If you're above the 300,000, hopefully there's money in the estate that will help, but that cap is set by the legislature. I mean, 300,000 for long-term care is pretty common across the country. There's some as low as 100,000. New Jersey actually has no limit on there for long-term care guarantee fund. California's limit is like 500,000, but it's called a cap, and that's what it means. That's the most a guarantee fund will pay.
And just to clarify, you keep referencing the estate, but you mean the sort of the bankruptcy corpus of the company, the insurance company that goes belly up, to the extent it did have some reserves and some cash on hand as it's liquidated. Some small portion of that would be distributed as additional benefits to each of the insureds.
Over and above the cap, yes.
Above the cap. Okay. Representative Matheson.
Thank you. Thanks so much for this information. Obviously, this is a big issue in my district because I've heard from many of the Genworth constituents with 122% increase rate requests. So I'm just curious, are you going to go over what is a normal percentage that you think is adequate for a company like this? I know that my constituent heard back from from somebody in your office that said that if it's higher than a 15% increase, then they usually try to encourage the insurance to spread that over time. This is obviously significantly more than a 15% increase. So I'm just curious, how are you going to address those percentages, and how do we address those with our constituents?
Well, we're going to I'm trying to be careful here because we haven't decided yet, but we're absolutely going to insist on giving consumers options. But the rate increase, Marty's, and she'll explain the analysis she goes through. We have two level of actuaries look at it, and that has to be justified actuarially. It's a pretty rigorous review, but there's no cap, there's no statutory cap on the rate increase. So it's difficult to say where we'll end up. I mean, they're just beginning the review. But again, we recognize this. I've never had 144% rate increase for 4,000 Mainers before. It's troubling, but you know, we'll deal with it. We'll look at the filing over as thoroughly as possible and arrive at what we think is an appropriate decision. But again, we will insist on giving consumers options.
Could you tell us when that public hearing is too, and how we can have our constituents be involved in that public hearing on December 4th?
Get a letter from Genworth. It's December 2nd in the afternoon.
December 2nd?
Yeah.
I can share the Bureau's notice with information about how folks can register. I believe it's going to be by Zoom, but there's information on their website, and I'll share that with the committee members.
Superintendent Chapa, is there some point in the review, and maybe this is something Ms. Hooper is going to touch on in her part of the slides, is there some point at which the Bureau would determine that 114% rate increase, for example, or some other hypothetical rate increase would cause, or should just be, the company should just be liquidated instead, or that it's evidence of insolvency? I'm trying to figure out what the line is there, where you say, you know, if you do this, too many people are going to drop out, and now you're in a death spiral, and we should just stop it here before more people drop out, because presumably those people who drop out in the last year aren't eligible for the guarantee funds when we put them into liquidation next year, for example. Is that true?
That's true, but it's up to the domiciliary regulator to put a company in receivership, and that's why I'm litigating in Pennsylvania. I can liquidate a Maine domestic, but I don't have the authority. I mean, I'm out for state-based regulation. It works well, but it'd have to be, in this case, it has to be Virginia.
Okay.
Put it in liquidation, but you're right. It's just chasing good money after bad.
And is there a way in which Maine can speak to Virginia and sort of talk about where that line is, for example? Is there an avenue for that?
Absolutely. We talk all the time. Scott White is, I actually, when we, as a commissioner of Virginia, when I was president and created the long-term care task force, I put him in charge. I mean, I talk to him frequently. And long-term care is an issue that comes up in every meeting. So yeah, we have those discussions constantly. There is an avenue, and they're robust discussions.
Okay. I don't see any additional hands. So if we want to go back to the presentation and run through the rest of the slides.
Next slide is just a little bit about Genworth. This is all public information. I won't spend too much time on it, but their AM Best rating is C+++, which the definition of that is from AM Best is it's marginal and assigned to companies that have an AM Best opinion and marginal ability to meet their ongoing insurance obligation. Financial strength is vulnerable to adverse changes in underwriting and economic conditions. So again, it's not the strongest company in their SEC filings. I just point you to the last bullet. If they don't realize future rate increases and associated benefit reduction, would likely have to increase its long-term care reserves by amounts that would likely be material and result in material adverse impact. So, you know, this is not an easy situation. I mean, it's my job, and we're going to do it. But I point this out. Just this is public information, but Genworth is a monoline long-term care writer, and if they don't get some increases, again, they say it'll have a material adverse impact on them. So I'll leave it at that.
Okay, Representative Matheson.
Can you define that, Superintendent? Material adverse impact, does that basically say they will be insolvent? What does that mean?
I'm not the CPA. It's not good. I mean, I can't say it'll mean insolvency because I don't really know. But I can say it wouldn't be good, and for the company to put that in the SEC filing, one, they have to. I mean, it's a publicly traded company. But they tried to. There was a merger pending for a number of years with a Chinese company that recently fell through. So this is their plan B. It's what we're undergoing now, and you can see they've had rate increases of in 2020 they got $1 billion nationwide, and now they're looking for 1.4 billion. It's a difficult situation. I know I keep saying that, but it is.
Okay, go ahead.
Now Marty's going to take over actually what we do in the rate review process. Marty.
Okay, thanks. Colleen, if you go to the next slide, I'd like to talk in general about the rate review process. And I think this is helpful when you get constituents that contact you. So with the Genworth, we've been contacted by people who say, I live in Virginia. I don't understand why Maine is making the decision for the rate increase. Maine Bureau of Insurance has jurisdiction over policies, individual and group, that are sold in Maine. So some of the Genworth are AARP policies, that were part of a group, an association. So some of the ones that are not under our jurisdiction are those that are sold in other states. So if somebody moves to Maine, but they purchased it somewhere else, we wouldn't be reviewing that rate. Employer group policies that are issued in other states, they may have employees in Maine, but if the policy is sitused in another state, we wouldn't. And there's also fairly recently policies that get filed with what we call the Interstate Insurance Product Regulation Commission, or Compact. So if they approve the product, they do it for multiple states that have joined together for efficiency. They can approve rate proposals under 15%. The higher increases, they might review them, but then they defer to the states. So hopefully that gives you an idea of, there's a little bit of complexity there, but if the person bought it in Maine, for the most part, we've got jurisdiction. Next slide, please. So our rate overview, benefits must be reasonable in relation to premiums in the statute, the type
Excuse me, Marty, may I,
Yes.
I'm sorry, and Senator Seymour, may I ask a question? Thank you. And thank you very much for being here. Ms. Hooper, sorry, I shouldn't say Marty. Excuse me.
That's okay.
And I just, going back to the slide before, if you don't mind, Colleen, if you can. In terms of employer group policies issued in other states, I want to get a sense. We have some very big employers in Maine who may offer long-term care insurance in their benefit package, but those employers potentially could be considered out of state. For example, I'm thinking General Dynamics. Are they offering, do you know, a policy for long-term care insurance to employees of BIW?
I don't know. Unfortunately, our filings don't come in by employer group. So when our filings come in, it would just be on a generic basis, and it would say, group policies. The one I can think of is Unum, certainly has group policies, or did. They're not selling new group policies, but they still service their existing ones. But yeah, I don't have an idea of which employer has which coverage, and if it was issued in the state of Maine. I think certainly you could have a headquarters in another state, but perhaps the location makes the decision to purchase a Maine group policy. So as all things with insurance, it's not real easy. So I think the best way for somebody to find out is, perhaps contact their HR department and ask how their benefits are provided.
Yeah, thank you. I guess I'm concerned about the scope of the problem, and I'm trying to get a sense of the scope. Senator Sanborn has indicated that not very many employers are offering long-term care insurance at this point anyway, but I just, scope is an issue. That's what I want to get a sense of. Thanks.
Yeah, group policies are a little bit different than individual. They do tend to have a lower level of benefits. Oftentimes the employer might help contribute toward the premium or not. I mean, it depends. So we haven't seen quite as high increases on the group policies, the employer ones, as the individual, but that could change. As Eric mentioned, the whole industry is finding it difficult to continue.
Representative Bleier. Representative Bleier, I think you're frozen at the moment. So Ms. Hooper, go ahead and hopefully we'll get Representative Bleier back.
Okay, so let's see. So part of our review, as was discussed, we will sometimes negotiate a lower approved increase. And while we were discussing that, I did look back. We do have a spreadsheet where I track the different rate increases. And I was just looking at some general examples with Genworth back in 2018, they proposed a 67% rate increase, and we were able to negotiate that down to 26%. And as mentioned, we do request that the carrier phase it in. So 15% is kind of where we start. If the increase is really large, if we had to approve the 67%, we might not spread that out among more than, say, 3 years, because then the insurance company is, basically missing out during those years when the full increase isn't applied. So those are the types of things that we try to work through with the company. It's not required for the phase in, but most of them are pretty willing to work with us on that type of thing. And that helps consumers know that they're getting a large increase. They need to make decisions, because ultimately it'll get to that point, but it does give them chance to budget for that. So, being creative, trying to find ways to make this work. So next slide. I just wanted to give an idea. I know someone asked about the number of lives, and we don't actually collect that. We do collect the amount of premium. So this is an annual reporting. So in 2020, I just listed the top carriers, and Genworth is at the top. And you'll notice Unum is a little bit lower, and part of that's because they have more group policies and the premiums tend to be lower on those. There's 54 carriers, as we mentioned. That's a lot of renewal closed block business, and the total was $56.7 million in premiums collected for 2020 in Maine. So next slide. So our filing process, we have electronic system. It is available through public viewing on the Bureau website. A little bit technical to get through that, so please feel free to call the Bureau if you want some help in finding a filing or looking at one. We review it for compliance. Are they sending out notices? Have they given us all the data that's required? The actuarial memorandum lays out the reason for the increase and the assumptions. We can request all the additional information we need. There's a 30-day turnaround time to give the company a chance, to pull that data together. So sometimes these filings take quite a while to review. To give an example, the Genworth filings, they're expecting an effective date of August 2022 to give enough time for the review. And we also have contracted with an actuarial firm that's been working with us for quite a few years. They do an independent review. They work with other states. They've got some expertise and some staff to help us. And they will send us their recommendation. And, we use that and also our own review. It's based on a loss ratio. So there was some discussion about profits and, a lot of the consumer comments, I read them all, are concerned with, I've never claimed on this policy, how come it's going up? What we do is we look at national experience. Maine experience usually isn't credible. There's not enough to really analyze the data. The old policies were required to, I think that's on the next slide, Colleen. Get ahead of myself. So the older policies that's issued prior to October 1, 2004, they were priced at about a 60% loss ratio. So that was the original. And, commissions were high for these products. They could be anywhere from, I think, 10 to 24%. And then, profits could be anywhere from, 8 to 10%. Certainly these blocks are struggling to continue to be profitable. They're projected to be much higher than the 60% loss ratio that they originally priced at. Next slide, Colleen.
Ms. Hooper, can I just get clarification there? Because we have talked about loss ratio and other contexts in the committee. So they originally were priced at about 60% loss ratio, but you're saying their experience loss ratio is much higher, meaning that they're paying a much higher percentage of the premiums collected toward claims each year. Is that right?
Yeah, so to get a little bit more into the weeds with it, and, I think everyone understands loss ratio now because of the ACA, it's, claims to premium. So with long-term care, it's a long tail product. A lot of people buy it and have it for 20, 30 years before they may end up needing it, different than medical health insurance products. So some of these blocks of business currently are at 12 to 20% loss ratio, but their projections through the lifetime of the policy are much higher. So what we require in a rate filing is to demonstrate the lifetime loss ratio. So the 60% was what it was priced at, but any rate increases, and this is what I'm trying to demonstrate in this slide, the increase must be calculated such that an 85% for the additional premium needs to be met. So what we call that, it came with, the NEIC had a model called the price stabilization for long-term care. They were encouraging the companies to price it adequately and put kind of a penalty on what's required for an increase. So that's a little trickier than medical policies because it's the increase that's at the 80%. So what you'll see mentioned in our regulation is a 58-85. Past losses are required to meet a 58, or sometimes we'll review it and look at what the target loss ratio was if it's higher than 58%, and then the 85 for the increase. I know that's fairly technical, but that's really what we're looking for. We look for other things. I think, let's see, Colleen, the next slide. I'm trying not to get ahead of myself too much. Yeah. So the other things we look at are the assumptions, mortality, morbidity, and lapse, and the timing of that rate increase. So the loss ratio is a big part of it, but when they project out their experience, that's based on what they're using for assumptions for mortality. Is, how fast are people dying? Are they dying once they're on claim? How long does that take? Morbidity is how sick they are. How long are the claims going to last? And then, of course, lapse. Are these policies dropping? And, when we talk about lapse, it's usually due to death, right? So somebody dies before they actually collect on the policy. So those premiums get spread across the rest of the block. One thing to consider is if we do lower increases or spread them out, the longer an increase gets delayed, the more the company needs it. So we have been proactive, trying to push down these rate increases, continuing to look at experience, hoping the experience would improve, in future years. But sometimes you are kicking the problem down the road. So we do want policyholders to understand that these rate increases could continue, as Eric mentioned. We're also concerned with the solvency of the company. We can't, simply deny a rate increase and hope it goes away. The problem continues. And as we mentioned, a big part of our discussion with consumers is the alternatives, the benefit reduction options. And I think you can go to the next slide, Colleen.
Representative Matheson has a question.
Thank you so much, Madam Chair. Just wanted to clarify the carriers versus the companies. I know that Superintendent said there are only 7 companies that are offering this service, but then you indicated there are 54 carriers. I'm not sure I understand that breakdown. And also, can you clarify how many complaints the Bureau has gotten based on this Genworth increase?
Yeah, sorry to confuse. With long-term care, once again, different than medical, there's a lot that are renewing in closed blocks. So there's only 7 companies currently selling, but there are 54 companies that have main policies that are guaranteed to renew. And some of these blocks are quite old. I don't remember where, like we mentioned, I think the first slide, early 80s, possibly we could have some policies still. So that's why there's so many companies. They're no longer selling. A lot of companies did not find it profitable or too risky and left. I'm sorry, what was the second question? I had it in my head and it left.
No worries. Thank you. That helps me a lot. Just curious how many complaints this Bureau has gotten now.
Thanks. I know it was an easy one. I just slipped my mind. Yeah, so gosh, when those letters reached policyholders, Eric might have the counts because I know he was tracking it, but we may have gotten like 200 phone calls the first day. So yeah, there were a lot of consumers. And then on top of the phone calls, certainly we got written comments and questions, and we've been trying to answer those as quickly as we can. We may have gotten anywhere from 5 to 10 a day for the past week and a half. So it's been a hot topic. But I find that a lot of what we try to do is inform the consumers. Unfortunately, those letters that came out didn't give them the options, and I think scared a lot of them. You talk about somebody who may not be able to pay the premium any longer. One of the options is you can choose a paid up reduced policy if you really feel that you just do not want to pay the premium any longer. There are also options to reduce your benefit levels to the point that you're paying the same premium that you had been paying. What's hard is once you've reduced your benefits, a few years go by and the company wants another rate increase, and you feel as though you've reduced it as much as you can. Sorry, I guess there's more questions.
Representative Tepler, go ahead. You're on mute. Representative Tepler, you're on mute.
Sorry, Madam Chair. I think Representative Evans was before me, so I will yield to him and then ask to be heard after he is.
Representative Evans.
Thank you, Representative Tepler. I'm just having a hard time trying to wrap my head around the number of people in Maine that we may be talking about. Is there any way to find that out at all?
I think we could look through our filings and come up with a rough number, just from the different filings we have. So we'll put together something and get that to you. I off the top of my head, like I said, we don't have a good way to collect it.
So at least to answer that question, I think I heard the number for Genworth as 4,000.
Right, the filing we were looking at, Unum, some of their prior filings have been 8,000, 4,000. So as I mentioned, they have a large number as well.
So, Unum was located in Maine. Ms. Hooper, is it true that Unum's no longer selling long-term care?
Correct. They still service their existing group policies. So if you're working for an employer that, had offered that, you may still be able to get that as an employee or dependent.
Yep. Representative Tepler, go ahead.
Thank you, Madam Chair. Sorry. I am wondering if, Ms. Hooper, you think that we might need a tweak to current law, that the notification of the rate request increase include the possibility of options that might be offered so that people don't get quite as concerned. Although, on the other hand, I'm glad they're getting concerned and notifying the Bureau of their concern rather than having to wait until after the increase or whatever increase may be chosen is passed by the Bureau.
That is something that gets discussed by states, and different states have different approaches. I think I just read an article in South Carolina's approach, and they have certain requirements on what gets put in the notice. So that's something we could work on. The later notice, when the increase is actually approved, does include that type of information. So, it's almost a chicken and the egg. We like people to know an increase is coming. Unfortunately, they do get quite alarmed. In this case with Genworth, maybe they never would have seen that the request was 144%. They might have only seen the actual approved amount. But you're right, it gives us a chance to communicate with consumers. I just would feel terrible if somebody thought they had to drop their policy and didn't realize they could get a paid up. So some states have required a dedicated phone number by the insurance company to answer questions. So there's different things we could look at.
Representative Dyer.
Thank you, Madam Chair. Thank you, Ms. Hooper. My question is, you said Genworth had 4,000 policyholders and Unum had 8,000 to 4,000 policyholders. And my question is that you made reference earlier that some of these policyholders may not be Maine residents. And I'm wondering, is that the 4,000 and the 8,000, those are Maine residents, or those are total policyholders in as a whole?
Yeah, thanks for that clarification. As I mentioned, right, we are reviewing filings for policies purchased in Maine. So some of the phone calls we've received, as I mentioned, we're someone in Maryland or Virginia who had moved. Mm-hmm. So it would be really hard to, I think, figure out how many are Maine residents.
So these are policyholders who are governed by Maine law, maybe as a way of describing it, as opposed to Maine residents.
Yeah, and on the flip side, you could have a consumer who purchased it in, say, Texas, and may contact you and be upset at the rate increase they're getting. We get a few of those calls as well and have to explain that it's governed by Texas if they purchased it there.
Yep. Do you want to continue your slides? I don't see any hands.
Okay, just quickly, because I know we've been talking about this a lot. I just tried to give a picture of, what we're reviewing in a year's time, and that we do deny increases. We also reduce them, but then we also have been approving them, and some of them have been quite high. So next slide. And here's just a quick look at a few that have been recently approved. So as I mentioned, some have been quite high, and on all of those, we have asked the company. I believe all companies have been willing to phase them in over time. Next slide.
Representative Matheson, I think, has a question on this slide, as do I. So
Okay.
go ahead, Representative Matheson.
Thank you. So if I'm reading this correctly, the recently approved rate filing approval for Genworth, which is the one that I get to talk about a lot today with everybody, was 53%. And what they've requested is 144% increase on top of that for the next year. Am I correct in that?
Yeah, and I'm glad you asked that question. It gets confusing. As I mentioned, so the companies file blocks of business when they file their rates. So they don't file a rate filing for the whole company's business. The blocks are based on kind of product offerings that they introduce at different periods of time. I'm not an insurance company salesperson, but they have some type of strategy, I suppose, or innovations. And so they might bundle those into like a block of business. So that Genworth rate increase that we're looking at was actually one that was approved in January that had been filed in November. And that was, I'm just looking at my spreadsheet, there were there were two at that point in time, and then there were a few the year before. So they don't all come in at the same time either. Hopefully that helps.
Not really, but I appreciate the information. Maybe from my constituents' point of view, from 2014, from the 13 constituents that I've been talking to, their rate increases from 2014 in terms of the premiums have been 100% from 2014 to 2019. And then they just received this rate increase of 102 to 122 to 144%. So it's very hard to have that conversation with them when they already saw over the last 5 years 100% increase in their premium. So I don't know how to have that conversation. When I see this slide, it makes me even more nervous that this increase happened last year and that they're asking for such a big increase this year just on this one piece. But if I understand you correctly, Marty, you're saying that this includes a lot of different policies, not just long-term insurance in that 53% increase? No?
So they're all long-term care policies, but different blocks of business will get submitted at different points in time. So you are right. The ones that are contacting you that received a letter, that are looking at an additional 100 to 140% increase have also had prior rate increases. And, there was a point in time I really thought the companies could do a reset, raise their rates and we'd be all good for a while. But as Eric had mentioned, the experience continues to worsen. The companies are continuing to find that they're not collecting enough in premium. So we're seeing year over year rate increases across the whole industry. And, some of them will wait a couple of years. If we have pushed down a rate increase, they're very apt to come back to us year after year requesting rate increases.
Ms. Hooper, so my question was, and I see your hand as well, Representative Tepler, but my question on this slide was whether the 53.4% increase that's reflected in this slide is the same blocks of business or whether it's non-overlapping. And I think, so that's a slightly different way of asking Representative Matheson's question, I think, but which might help us be able to communicate better with our constituents. It's not as though Genworth came in last year and asked for 53% on the same exact policy holders that are now getting 144%. Is that correct?
Yeah, that's correct. So what we do is we track it by form number.
Yes.
And a policyholder can actually look. It's a number that's in the bottom left-hand corner of their policy. Mm-hmm. So that one that I put on the slide that's confusing everyone is form 7046, for example. And the ones that we're looking at now are like 7,000, 7042, 7044. So the last time that this block had an increase, some of them, there was an approval in 2019. So yeah, some of them have just gotten through like a 2-year phase in of a prior increase. Yep.
Okay. Representative Arford.
Yeah, quickly, just for level setting, are there parts of the state, you may not know this, but if you do, are there parts of the state that sell more of this Genworth product than other parts?
I don't know. And there is no geographic rating as there is, like we're used to, in medical insurance, there's geographic factors. That's not typical. That's not used for long-term care. So I don't have any sense of, where these policies are in the state.
The reason
Representative Arford, I noted the same thing. Representative Matheson has certainly heard from a lot more constituents than I have. And I suspect that might be the result of a broker who, sold a lot of these in a particular area of the state 20 years ago or whatever it might have been. So I suspect that it has to do with a particular broker who just, preferred this brand of long-term care at some moment. And these constituents just happen to still live in the area where that broker initially sold them to. So that's just a guess, Representative Arford, but I wanted to share that I had also had that kind of reflection of why has Representative Matheson heard from so many folks? So I don't know if that helps ease your mind there, Representative Arford.
Well, I'm hearing about a lot of things, but I'm not hearing about this. So I was wondering.
Yeah, I think that's the answer. And I have not heard from a lot of my constituents either, which suggests to me that just other brokers in this area were selling a different brand of long-term care insurance. I know a lot of my family members, for example, have Unum policies. So just a different brand.
Thanks.
All right, go ahead, Ms. Hooper.
And I wanted to put a question out to Superintendent Chapa. Did you want to speak on the NEIC or do you want me to cover this slide?
Why don't you cover that slide, Marty, and I'll just finish up at a higher level with the EX task force.
Okay. All right. Just wanted to make sure. So here's a list of the National Association of Insurance Commissioners, NEIC, some of the different work groups that are looking at long-term care. So Senior Issues works on the models. This is the regulations that they suggest to states to adopt that involve notices, consumer outreach, as well as the rate increase requirements. And then Eric is involved in the kind of the executive task force level of commissioners. They've got 3 different subgroups that deal with solvency. There's a multi-state rate review to do some standardization and also looking at reduced benefit options. And then there's a group of actuarial work groups. We look at pricing, the valuation, which is, the reserves and the solvency of the companies. So there is a lot of work. These groups meet sometimes monthly. And then we have our national meetings. We share ideas with other states. Experience with filings, if a filing comes in, I can reach out to other states, other actuaries. So there is a lot of coordination among the states. So next slide. So I did want to touch a little bit on the partnership because this is also a possible policyholder question. When they're looking to reduce their benefits, they do want to consider their partnership status. And partnership status is something that gives them the ability to be eligible for Medicaid without, I want to say burning through their assets, spending down there, I get the right term. So on that second row there, it talks about asset disregard. They'll get a dollar for dollar offset on the benefits paid through their policy. There had been stricter inflation protection requirements. Those were reduced recently through our bulletin. So it's something worthwhile to ask, whether a policyholder has an investment advisor or, can find out how to protect that partnership. Next slide.
Sorry, can you stop there for just a second? Because when I was doing some reading about this, I wasn't clear on whether the Genworth forms that are under consideration today are partnership policies or whether they aren't.
Yeah, I was thinking there were some. So once again, we have a group of different filings. So there could be some that are affected, some that are partnership and some that aren't. So that's, like I said, it's pretty important for the policyholder. They usually know if they've got partnership to check and make sure any reductions that they're looking at. And most of them wouldn't, right? I believe you can reduce your daily benefit, your lifetime, those types of things. It's the inflation protection that remains the criteria. And now I believe it's fairly low. Used to be, the 5% was kind of a standard that got offered, but really a 1% is closer to what people are often reducing it to.
So my question around this, Super, is when the notice goes out to folks after the review, will it make clear that they may lose their partnership aspects if they choose certain benefit options? Because I want to make sure folks don't have to go to an independent advisor in order to understand their letter. And it's good for the state if folks have these partnership policies and keep them in place, I think.
Yeah, the notices do bring up the issue. I don't know that they're definitive about what level reduction would, I think, and I could pull it up as we're talking. I think it just recommends someone, seek some help on, making that determination, whether it's talking with Genworth or it's talking with, somebody else who can give that information.
Okay, because the partnership piece of this is something that, it's about really DHHS's regulations, right, with regard to how main care is going to come back after your assets after you've passed away. Is that right?
Yeah, so I think that's what makes it complicated. It's an interagency coordination. For our public forum, we will have one of our attorneys, Pam Stutch, who is more versed on this than I am. And she will be there to answer some questions. So we can ask, that she talk about that in some more detail.
Okay. I do think this is an interesting sort of wrinkle in the entire thing. And I just was doing a number of folks have asked about the scope of the problem, trying to wrap our heads around the scope of the problem. I found one data point online while we were talking that said only 5% of long-term care costs are paid for by commercial insurance, private insurance, and that about 57% are paid for by Medicaid programs. And that's nationwide. So maybe it's a different mix in Maine, but something like 5% of Mainers might have these policies. would be my guess. So we're talking about a pretty small percentage of folks that still have these policies.
Yeah, I think those numbers are probably close. Yeah, for Maine as well.
Okay.
So just quickly, we've talked a little bit about this already. When the Bureau receives a complaint from a consumer, we'll check jurisdiction, verify that it was an approved rate increase, and try to, answer any questions and also encourage them to look at their alternatives. So next slide. And then some of the different alternatives we talked about: reducing the inflation protection. There's people with 5%. That seemed high until this year. Now we're looking at inflation again in the economy. But I think it's really important for somebody to not look at the daily benefit amount when they purchase the policy. I really encourage the insurance companies on the notices to send out the inflation amount. So if you purchase it at $150, that's gone up because of your inflation protection. So you could reduce your daily amount and still have it, close to what is being charged currently. A lot of those have gone way up above. And then other things, the elimination period, you can increase it 90-day if you feel like you can afford to cover the first part. And as I mentioned, there's the non-forfeiture, which we call, that's the paid up if you no longer want to pay premiums.
Ms. Hooper, I know some, I'm more familiar with life insurance policies. I know some life insurance policies would have this sort of paid up benefit and others would not, and it's based on the original contract that you signed.
Yes.
Is there a circumstance where the Bureau is actually imposing some additional flexibility or payout rules on the companies that actually go up above what was in the contract that was signed, that require these additional options, the menu of options for you? Is that what's happening, where the Bureau is saying you must add these additional contingent options to your contract if you want this rate increase? Is that how this is being done?
Yeah, that's a really good question. And that's exactly it. Some people, when they purchased their policy, actually chose that as a benefit option. So they, would have paid premium for that extra benefit. But there is a requirement in our regulation, and it's an NEIC model. So other states have it as well. If the cumulative increase goes above a certain amount based on age, it's a table in our regulation. I think for the most part, these Genworth people are reaching that. Very often the companies are also extending that, recognizing that these increases are quite high. So when the policyholder receives the letter of the different types of options, it will mention that even though you don't have this as a option in your contract, it's an additional option being offered by the insurance company. So yeah, we've definitely been encouraging that type of offering. I'll have to say it's not taken very often. We've asked the companies, they have not found that people want that. It's a reduced benefit. These are still really good deals. Aside from some of the solvency concerns, I have had consumers say, I met with a financial advisor. They told me to hold on to this because they're no longer available for sale. They still are very generous in their coverage. Somebody pays $60,000 in premium, but they could be looking at getting $1 million in benefits. If they've got a lifetime and, they don't have they have a lifetime period and not a lifetime maximum. Some of these policies, are very generous. So it's really a personal choice, and that's what makes it hard. Someone really has to look at their finances and decide, do I want to pay the increase or do I want to reduce the benefits? Very personal choice. Unfortunately, we can't say that the increases won't continue. So they also need to factor that in. So long way to answer.
No, it's a really helpful answer though, because I think one of the themes that I've seen in Representative Matheson's emails has been that concern that you paid in all this premium and now it's just gone. And so it's helpful to know that the Bureau can override that provision in the original contract if someone didn't choose to have that paid up benefit to begin with, which I assume a lot of folks didn't choose that option. All right.
So I think the next slide is a really good visual showing, that if someone had some of these inflation protection, as I was mentioning, you start out with 150 daily benefit, you're way up over 600 after, the number of years it takes before you might claim. So it's worth revisiting it and seeing, do you need it that high? A lot of the companies started out, they'll allow you to keep the level you've reached, but not continue to increase if you want to keep your premiums, what you're paying right now. So it's not necessarily a terrible thing to, reevaluate your benefit levels. Okay, next slide. And here we are, talking about the paid up. So as I mentioned, the regulation, it's triggered by the cumulative increases. This is just kind of the details that are in the regulation. So it is a limited policy, but it does give you something. So if you're in that situation where you want to choose that type of benefit. All right, next slide. We talked about this earlier, the Maine Life and Health Guarantee Association. Eric covered it pretty well, so I won't go over any more. I did want to mention the bullet at the very bottom. They still are able to request rate increases, right? So if a company goes into liquidation, they look at the assets that are there, they're trying to pay out the claims as well. They may find that they have to request a rate increase. In the past, like with Penn Treaty, the states approved the rate increase. As Eric mentioned, with SHIP, our concern was that Pennsylvania was deciding on the rate increases. So just to, kind of a cautionary, the Guarantee Association isn't necessarily the solution. There's still difficulty with that. And then I think I am handing it over to Eric.
Thank you, Marty. I won't spend a lot of time on this, but this is just what's going on nationally. Marty touched on them. Again, what we've described, this presentation could take place virtually in every state in the country. It's really it's truly a national problem. And one of the problems is there's such variance in states approving rate increases. Those states that have approved higher rate increases than other states are basically subsidizing those lower states. And that's become a real issue and a real flashpoint, rightfully so. So what this is trying to do is come up with a multi-state rate review mechanism that is voluntary, but really is not dispositive of the filing, but really it's supposed to be, you should have a good reason not to follow the multi-state rate review process. It's actuaries around the country, some of the best of the best, Marty's included in some of the discussions, and it's just trying to get more consistency from state to state, because when this problem first arose, we had some very large states saying, I'm just saying no. And we had some states, one state actually said to a domestic, well, to a company, it's not like you're one of my domestics. Well, that just exacerbates a problem. And this work stream is in recognition that we need consistency from state to state, because it is legitimate if one state is subsidizing the other, that state has growing concerns. The other is more consistency in making sure the option for consumers when they have to reduce their benefits are consistent from state to state and substantive from state to state. We're trying to, the work stream is trying to work up that. So, and along with that is the education and the explanation of the benefit reduction options for consumers to make those more consumer friendly. And finally, there's a whole bunch of work going on solvency of long-term carriers, especially with the reserve adequacy. You will see other carriers adjusting their reserves. You can't solve a problem until you know the scope of it. And then we really need to make sure we understand the breadth of the problem, and where we're starting is the reserving and the financial condition of the companies themselves. And there's a lot of work going on there. So those are the three national work streams. They've been going on for several years, and we're starting to come up with some recommendations. With that, available to answer questions. And again, we very much appreciate the committee's interest in this problem. It's a difficult one, like I keep saying.
Representative Matheson.
This slide, that last slide might have answered my question, but I'm just wondering if Maine, it builds on Chair Sanborn's question about where my constituents can go once they get this letter and get educated on how to reduce their in their long-term healthcare policy. I know that we will receive calls from them asking us, how do I navigate this? How do I educate myself on how to reduce my benefits? So I'm just curious, in Maine, from our perspective, is there a location that we can send them to so that they can figure that out?
Well, I have a bias for them contacting us. Unfortunately, we're not taking members of the public face-to-face yet. Hopefully we'll be there soon, because I know elderly people in particular like face-to-face, and I consider myself elderly these days, and I prefer face-to-face. So I hope we get there. But again, I think Marty's staff does an excellent job of explaining the issues and explaining the options. So I have a bias there, but these other options are available as well.
So if I hear you right, Superintendent, you're saying that I could send one of my constituents to call the Insurance Bureau when they get this letter and say, can you work me through this and explain to me how I can change my policy so that I can still afford to do this, or whatever my options are? Am I hearing you correctly?
We can explain them. We won't go towards recommending, though. That's probably a step too far, where some other, like the agent or attorney may recommend, but our job is to explain, and I don't mean that the way it sounds, but recommending it carries, implies that would be the state recommending something, and if it's incorrect, I would not want to put my staff in that position.
Yeah, I would just say these get complicated because there's a lot of financial considerations. So the Bureau has not really got into the business, like Eric mentioned. Yeah, it would be hard for us to make recommendations. We can certainly answer the technical questions, but that's why I'm hoping some of these other resources, talking to the company, certainly if they've got an agent, investment advisor, hoping that some of these others, maybe with the combined questions answered, that they can put the pieces together. But yeah, it's a hard decision to make. And we're hoping that the more information we can give them, the better they're able to make that decision.
Representative Tepler.
Thank you, Madam Chair. I'm thinking about the going forward issue for consumers, and wondering if there's anything that we can do, and perhaps the Bureau doesn't necessarily have this kind of thought process, but the committee could put their heads together and think about, is there anything that we can do as a committee to protect consumers going forward from these situations. And maybe it has to do with new policies as opposed to existing policies. But I am just thinking about this as an ongoing issue, and whether there's something that we can do to help the kind of people who are especially vulnerable to these problems.
I can't answer that question, of course, but I will say the newer policies, you're seeing more hybrid policies, and Marty can explain them in more detail, being sold these days, like a long-term care rider with a life insurance policy. The life insurance policy, if someone goes into a nursing home, they'll pay up to the limit of the life policy. Those are the type of policies being sold today, because quite frankly, I think the industry is pretty well demonstrated they can't get their arms around the product where you sell, that's going to be in existence for over 30 years and keep a level premium that they haven't demonstrated the ability to sell that, and they're voluntarily, well, not voluntarily, they're changing the product to hybrid, because as Senator Sanborn pointed out, only a very small percentage of people have these policies, and there's a tremendous need for some sort of product that works. I'm not sure, but I'm pretty sure that the current product that we've just finished discussing isn't one of them, but the hybrids are bring more certainty, and I think those products have some value.
Okay.
Yeah.
No.
Representative Arford.
Along with this being a small percentage of the market, I'm also wondering, are they, in terms of looking at the whole market of insurance products, I know, like, for instance, with health insurance, the profit margin of the insurer is basically controlled, correct? Like at 20 for whatever the percentage is. When you do your rate reviews, I'm assuming that that's part of your consideration, what you allow for the company's profit margin. And so with this particular line of service line, is there profit margin? What is their allowed profit margin? And how does that relate to all the other lines of business? Is it pretty much the same?
So Representative Arford, we saw a slide earlier about that the increases have to have a ratio of 85% going to claims and 15% going to administrative costs. Administrative costs in that scenario includes profit. So the amount of the increase is limited. So I don't know if that's helpful. I don't know if Ms. Hooper or Superintendent Chopper want to weigh in on any of that, but I think it was in the slides.
Well, Marty can answer, fill in, but most of the older blocks, they're reportedly just trying to break even on the older blocks that are subject to significant rate increases. But there's no statutory guidance on the profit by line, but it varies by line. It's no different than auto or homeowners, or health insurance is probably the only line where the profit is regulated by the MLR. I mean, there's nothing that says Anthem or Community Health Options, this is limited to a 3% profit. That comes out of the MLR requirement. So Marty, you can add in if I.
Yeah, no, I think that was pretty well covered. As we mentioned, yeah, some of these blocks are in dire situation, so the company isn't expecting to get necessarily profit out of the older blocks. These are for-profit companies. They do have to meet the obligations, of their stockholders. So they are attempting to, still pay out expenses for claims. They do have, in the newer blocks still could be profitable, but they are held to, with those increases, the 85% on the increased amount. Above that, we don't regulate what they do with the remainder of the money, how they distribute that. And then on the other side of things, as we talked about, they are required to hold reserves and strengthen those reserves when it's needed. So there is examination done on the financial side as well.
That's an important point, is they can't recoup past losses, but the reserves, that's what a reserve deficiency reflects past losses. So they have to make it up somewhere else. And for some companies, particularly the monoline long-term care companies, that's where the issues arise. There's nowhere else to make it up.
Yep. All right. We've gone significantly longer than I anticipated, but I feel like we had an excellent discussion and maybe a sort of 300 level class on long-term care insurance today, which I think is really, really helpful for this committee. I hope that folks found it informative. Are there any last questions or comments before we wrap up? Okay, I want to really thank Superintendent Chapa and Ms. Hooper and Mr. Yardley, who we didn't get to hear from, but who I know has been listening intently and helps put together some of the materials behind today's presentation. But they immediately jumped at the opportunity to give us this briefing with no hesitation, which I really appreciate. And I do think this is one of those circumstances where we just have to really understand what's going on. Superintendent, I will just say for my own account that I think the multi-state rate review possibility and trying to reduce cross-state subsidization as we all tackle this same problem together is something I really encourage you to continue to pursue. And I know you've been a leader in that regard, and I hope you'll continue to be a strong voice so that those 4,000 Mainers aren't subsidizing the thousands and thousands of policyholders in other states at the end of this rate review or others in a similar situation.
Yeah, I agree.
Great. All right, seeing no further hands up, I will wish you all a wonderful weekend and a happy Thanksgiving, and I look forward to seeing you all again soon.
Happy
Thank you.
Thanksgiving.
Bye. Thank you.
Thank you. Bye-bye.
Get your boosters.